The T accounts are the best way to understand how the journal entries are processed in the accounting system. This video will guide you into creating effective T accounts for a perfect trial balance. Welcome to Accounting Zero to Hero. We are here to help you understand the fundamental accounting concepts through simplified technical discussions and practical applications of the accounting standards. All of this to help you go from zero to hero. Now let's go back to the video. Simply speaking, T accounts are a visual representation of an account ledger. Each account that is created and already exists in the accounting system has their own separate T account. In basic accounting, we use T accounts to visualize the next steps that come after we post a journal entry. As shown in the screen, each line in a journal entry is affected into each T account. As each journal entry is posted, the numbers in the T accounts pile up towards the end of the year. And then at the closing date, each T account is summarized into one final figure by adding all the debits and all the credits. This total then eventually flows into the trial balance. The trial balance is then further summarized or aggregated into the financial statements. But wait a minute. That's almost a high-level summary of the accounting process for you, except for the closing entries, I guess. An ideal T account has the following parts. Debits and credits. All T accounts should consistently have debits on the left and credits on the right to avoid confusion. Dates. Just as a journal entry should have a date, T accounts should include this to remind you what is the effective date of the transaction. Description. The amounts won't make any sense without a simple description. Total. All T accounts have totals because the gist of this is to summarize all transactions during the year affecting the account into one single total. T accounts can either have a net debit or a net credit balance. A net debit balance means that the total debits during the year is higher than the total credits during the year. This is very normal for both assets and expenses because these accounts are increased through the debit side of the T account. In addition, for example, for cash, we do not normally spend or credit more than the cash that we actually have. That's why assets and expenses normally have a net debit balance. A net credit balance means that the total credits are higher than the total debits. This is normal for liabilities, equity, and income accounts, since these three elements are increased through a credit. Same as with cash, this happens, for example, for liabilities because we do not normally pay or debit more than what we owe or more than what we credited to the liability account. So when you add up all the net debit and net credit balances of all accounts in the accounting system and summarize them in a tabular format, this is what we call the trial balance. It goes without saying that to be able to come up with the correct trial balance and eventually the financial statements, you need to do the T accounts perfectly. In future videos, we will learn more about the accrual basis of accounting and the different closing entries that we need to consider to be able to finalize the trial balance that we need to generate as at the end of the period. And that's it for now. I hope you learned something from this video. If you liked what you saw, please make sure to subscribe and turn on the notification bell. You can also send some love in the comment section if you want to recommend a specific topic. See you!